So on February 27th, the Indian stock market had a bit of a rough day. But for one very specific group of finance companies, it wasn't just rough, it was a total cliff dive. Today, we're going to unpack exactly what happened, why it happened, and what it might mean for a massive multi-billion-dollar industry. Let's get right into it.
So, what was the trigger? I mean, what caused this sudden panic? While the rest of the market was dealing with all the usual global pressures, this particular sell-off, well, it was kicked off by a single powerful event happening hundreds of miles away from the trading floors in Mumbai.
And this shows you just how bad it was. I mean, take a look. In just one day, Fusion Finance lost a staggering 11% of its value. L&T Finance and Utkarsh Small Finance Bank both dropped 5%. Now, for investors, these aren't just numbers on a screen. These are massive alarm bells ringing loud and clear. And they all started ringing because of one thing. And here it is, the source of all this chaos. A brand new piece of legislation called the Bihar Micro Finance Institutions Bill of 2026. Now, to really get why one state law could send such massive shockwaves through the national market, we first need to be super clear on who we're talking about. We're talking about microfinance institutions, or MFIs. These are the companies that give out small loans, often to people in rural areas who just can't get a loan from a traditional bank. It's a huge industry, and as it turns out, the state of Bihar is basically ground zero. Just how important is Bihar? Well, it accounts for a massive 15% of the entire country's microfinance business. That makes it the single biggest market for these lenders. So you can bet that when Bihar decides to fundamentally change the rules of the game, everyone in the industry, and especially on Dalal Street, pays very, very close attention. So this is the big question, right? What is actually in this bill that got investors so completely spooked? Let's break down the key parts that are changing everything for these companies. Okay, let's walk through this. First, every single MFI, even if they're already licensed by the RBI, now has to get a separate registration from the state. Second, they need to get approval from the state's finance department before they can even give out a loan. Third, new caps on how much interest they can charge. And fourth, and this is a big one, a person can now only borrow from 2 MFIs max. Each one of these steps just adds a whole new layer of red tape and friction. And make no mistake, the state is not messing around here. That first step, the mandatory registration, the new law makes it a criminal offense to operate without it. Think about that. This isn't just a fine anymore. We're talking about a shift from financial regulation to potential criminal liability. And for an investor, that is a whole different ballgame. But, to be fair, this didn't just come out of thin air. There's a real backstory here. And if you look at it from the government's point of view, they felt this law was absolutely necessary. So let's take a look at their side of the story. The whole stated purpose of the bill is to protect borrowers. There were growing reports from the region about people getting buried in debt, facing really aggressive, sometimes coercive loan recovery tactics, and getting stuck in a cycle of taking out new loans just to pay off the old ones, creating what some were calling a deadly debt trap. This law is Bihar's answer to that growing crisis. All right, so now we have both sides of the coin, the government's reasons for the law and the law's tough new rules. So let's connect all the dots and get right back to that market panic and see precisely why investors hit the sell button so incredibly hard. Now, this is where it gets really interesting, because the numbers tell the whole story. Just look at the direct correlation. Utkarsh Bank has a massive 46% of its MFI business in Bihar, and its stock dropped 5%. Fusion Finance, 19% exposure, boom, down 11%. You can draw a straight line from the risk in Bihar to the market's reaction. But the real fear, it's actually even bigger than this. See, the real fear for the market isn't just about the 15% of business happening inside Bihar. It's about the other 85%. The fear is something analysts call precedent risk. The absolutely terrifying question for investors is this: what if other states look at what Bihar just did and think, hey, that's a pretty good idea? And this quote from Saurav Chowdhury at Raghunath Capital just nails it. He says, markets are reacting to that precedent risk. Because if this model gets copied in other states, then the entire industry's ideas about future growth and how much these companies are even worth, all of that could get thrown right out the window. It stops being a Bihar problem and becomes a national, systemic one. Which leaves us with the one big, lingering question. For years and years, microfinance has been this high-flying, fast-growing sector. The Bihar MFI Bill has put a giant question mark on that entire story. So, is this just a temporary speed bump, or does this mark the beginning of a brand new,
much more regulated and way slower growth era for the entire industry. The market has made its bet. Only time will tell if it's right.
So what do you think about all this? Let us know down in the comments. And hey, if you found this breakdown useful, you know what to do. Don't forget to like, share, and subscribe for more. Thanks for watching.